Larry, I want to talk about kind of the cut sort of behind the nothing today. But first, I want to talk about the market overall because we're now in negative territory for SPOOs. And I just checked the interest rate probability of a cut on our Bloomberg, and it's literally changing by the second here. It got as high as 80% earlier this year. It was roughly flat when we just started the show 45 minutes ago compared to yesterday. It was at like 60, 70%-ish. And it's kind of vacillating around there now, but going lower. So it seems like the market here is trying to maybe rethink that idea. What do you say?
Yeah, I agree with you wholeheartedly, and it's really hard to come up with a response because, you know, the yield curve, the probability curve is changing by the hour and by the minute, and I think, you know, whether you call it today a stealth easing or a non-cut cut, the fact is something happened today that the consensus wasn't really expecting it. So I think a lot of people are trying to make make a case for is it going to be on hold or is it going to be a rate cut? And I think, you know, the president was probably the only one who thought we were going to have a rate cut today.
Yeah. So this is important to separate two things here, okay? Because we're going to talk about the interest rate on an excess reserves first in a moment here, which got dropped a little bit, right? But firstly,
yes,
the market's response is what's really interesting because we've talked here, Larry, about the fact that the Fed funds were pricing in a cut, and then now Powell says basically, we think there's a possibility that inflation might come back, using the old transitory thing. We heard it a million times, but apparently still has the power to make the market rethink its assumption of lower rates in the near future.
Yeah, well, I think a lot of that is the market's overdone itself. I mean, if you look at
Totally.
twos, I mean, the two-year Treasury yields, they're trading, 15 basis points below effective funds rates. That's pricing in something. I mean, it's overdone. The appetite for the front end is very, in my mind, overdone. And that's what's caused a lot of the steepening, especially the 210 curve. But that said, we always see that where the market makes an initial knee-jerk reaction, waits a day, and then we'll probably see a whole different environment starting tomorrow, also putting the onus on BLS on Friday and also CPI PCE in the next couple of weeks.
So, Larry, this last push, I'm curious, this last push from like 2.6 on the 10-year, down to 2.5-ish, and I know you mentioned the 2-year as well. Have you been looking at bonds and shorting them? I mean, is the trade now for a calibration to the upside in yield?
Well, I definitely could see an upside in yields. That's something I've been saying for the last couple of weeks. I mean, long-term meaning 6 months. That's long-term for me.
Yeah.
I do think we'll be range-bound. It's hard to believe that 10-year yields were only down at 233 at the end of March, and it seems like we've come so far since then, but we really haven't. It's like 20 basis points, even though the market seems to be a lot more comfortable with the economic data story, the lowflation story, et cetera. So I think it's a range-bound trade. I continue to look at the spreads as opposed to outright yields. The only thing I would say, I do think the short end at this point is overdone.
Yeah. All right. Interesting. Larry, let's shift gears here because, the cut behind the pause was on, the interest on excess reserves, kind of like a sub-factor within what goes on in the range that the Fed gives us, right? Because I think sometimes, even though we talk about it so much,
yes,
people forget Fed sets a range, right? And it creeps back and forth. So it's basically creeping upwards, and they cut that now by 5 basis points down to 235. What does that mean to you as a bond trader? Anything?
Well, I think it does. I mean, right now, it's a reasonable response to the realities of the refunding market. That's what it is. We have to keep in mind that effective Fed funds have been above IOER and been rising since March, and I think lowering the excess reserve rate is just a way to stop the stubborn grind higher, because there is a fear that there's a spare capacity when it comes to excess reserves, and that's something the Fed is very cognizant of. So lowering it makes a lot of sense, and I think it's a third technical adjustment we've had in this IOER. It is a leaky floor, but the Fed can't pay excess interest to banks. I mean, the market's got to figure that out. So all that to say, I think it will be a good thing for the market, and it can be viewed as a stealth easing, as it were.
Okay, and the reason why I bring it up is because I thought it was interesting, right? You take that, which could be sort of a stealth easing, you pair it with some of the commentary on the comfortability of the economy from Powell, and you have a stock market now that's down and yields a little bit higher, despite the fact that there is this sort of, subcut.
Yeah, no, exactly. I mean, I was expecting to see 10-year yields go down, 3, 4, 5 basis points and close there. And I thought the curve would steepen beyond the highs of the year of 22 basis points, and none of that happened. So I really think it was an hour for people to digest all this news. And I think a lot of the curve is overdone. People are unwinding, and I think we're going to see some really good action between tomorrow and Friday.